Hello there and welcome to this episode of Africa Business Weekly as we bring you highlights of conversations that shape the business week across sub-Saharan Africa. I'm David Alabi. Now, this week's spotlight begins with West Africa as PricewaterhouseCoopers says Nigeria stands to benefit more from export of brain capital into high-end global value chains if it takes advantage of its large youthful population. Now, from our East African desk, we also explore expanding footprints of Islamic banking. Well, let's now delve right into our first cross into Palesa for updates from South Africa.
We're back for another week of Pan-African content. This week, we kickstart our conversation by reviewing investment relations between Mauritius and South Africa. Sectors such as manufacturing and trade, agri-tech, and the ocean economy are expected to fuel growth in the sub-Saharan Africa region. For more on the Mauritius SA investment drive, we caught up with Hemraj Remneil, chairman of the Economic Development Board in Mauritius. Let's watch.
We are continuing on that trend, In fact, this roadshow that we have, and we had also previous roadshows in the previous years, pre-COVID and also post-COVID. So it is a long story. It's a love story between South Africans and Mauritius, and I will say maybe connecting hearts because so many South Africans going there, having residence permits, holders, and also tourists, going to Mauritius. So it's a love story over the years, and it is being stronger. It's become robust, and you can see now the roadshow that we have. This opportunity is I would say, as the chairman of economy, is to say thank you to our partners in South Africa, because we had buyer sellers meeting yesterday. We had a business forum also last night. And we are moving to other places, for example, Cape Town and Port Elizabeth and also Durban. So all this is just to connect with the people and see how to build up our regional value chains. Because Mauritius, as I will say maybe in a way, it is in the axis of the economic prosperity. I will describe Mauritius, in the way, through Mauritius and beyond. That's my philosophy, and also government also is pushing for that, is through Mauritius and beyond. Because Mauritius is a small market, a small population. Yet, the trade agreement that we have signed over the years, you'll be surprised to see, we can access 75% of the world population. If the world population is 8 billion, we can access 6 billion. But we can't pretend to do that. We need partners. Partners are here in South Africa,
There is something quite natural about our relationship and our partnership. It's an easy flight to Mauritius, and the environments feel the same. When you're in Mauritius and in Johannesburg or South Africa, it feels more or less the same. But you have a vision, though, to grow our relationships by about $15,000 US. That's the number that you want to reach, going forward in terms of your own growth. Do you see South Africa playing a big part in that?
Definitely, because when we are growing on trade and investment, you see, and I will share with you, our FDI that we got last year, 2022, close to 28 billion, and that is a record figure for Mauritius. But in there, there's a big key contribution of South Africa, is about 15%. So the growth that we got last year of about 8.8%. Also, the contribution of South Africa is very significant. So I believe that, and we're looking forward that in 2023, we'll have more than last year's figure, and that will also trigger and support the economic growth that we have. And we reckon that, of course, we have challenges, as we know, all countries, that we're expecting just above 5 to 6% of growth this year. Yeah.
The World Bank expects economic growth in the sub-Saharan Africa region to slow to 3.1% in 2023 from 3.6% in 2022. However, my colleague Godfrey Mutizwa caught up with James Cust, the senior economist for Eastern and Southern Africa at the World Bank, to translate Africa's resource wealth into growth and prosperity. Let's listen in.
That's right. Well, so first is countries should do what they can to reduce the perceived risks of operating in their jurisdictions. And many of these risks are in perception rather than in reality, of course. And so you don't want to be giving away goodies for a perceived risk rather than a real risk. So do what you can to reduce those perceived risks, but then also recognize that the decisions that companies make about where to invest are not always about these tax incentives. The companies might ask for them, which is quite reasonable, but it may not be the determining factor. Now, add into the mix the fact that there's rising demand for many of Africa's metals and minerals. There's an opportunity, a window of opportunity, where there might be a slightly stronger bargaining position for governments. And so there might be an opportunity to have a higher rate of taxation overall.
Yeah, so we're going to call it the New Deal. Let's try and see if we can approach the New Deal in a better way so it benefits the communities. But on the tax administration side, you're speaking to transparency, isn't it? And we know this has been a challenge in parts of the continent in terms of the collection of tax and the efficiency of the tax authorities here. What are you guys recommending?
Yeah, so transparency is very important, and that can help align the incentives between companies and governments to collect the taxes that are owed. So we still encourage countries to sign up to the Extractive Industries Transparency Initiative, for example, but it doesn't stop with transparency. It extends to things like taxing the aspects of mining that are easier to observe, easier to audit, and then auditing based on risk. So actually auditing these companies on a regular basis builds a system of trust where they know they're going to be audited, and the countries are going to see what they're exporting, and there's an opportunity to tax that more effectively. But it's also about skilling up. So the movement of taxes around the globe through multinational corporations has got more and more complex over the last couple of decades. And so the companies have been investing heavily in how they move taxes and profits around the world. So countries should be investing heavily in how they observe those profits being moved around between their country and other countries.
Yeah. I remember a report a few years ago that was done by former South African President Thabo Mbeki, where I think the number that they put in terms of money that's moving illegally out of the continent was north of $50 billion every single year. So hopefully we can stem that. I wanted to talk a little bit more about the other government role, managing, of course, those resources once we are able to collect the taxes and getting the value out of the companies. How do we effectively do that? What are you guys suggesting?
Yeah, so it's very important what the governments do with the money, of course. It doesn't matter how much you collect in taxes. If the money is squandered, then it's not going to impact the lives of people. So one thing we really emphasize is governments should be investing in the future. And what does it mean to invest in the future? Well, the most precious resource that any country has is its human capital. So investing in the quality of education, investing in the people, as well as investing in infrastructure like transportation, is going to be really important for building a future that isn't dependent on natural resources in the years to come.
What about the suggestion that we perhaps could force, in some cases, reluctant governments to create sovereign wealth funds which are transparently managed? Would that be an idea?
So sovereign wealth funds are something that can work, and there are very famous examples like the pension fund in Norway has been very, very successful. It's not necessarily top of the list for what countries should be considering. Having a transparent and effective budget process is perhaps a more important priority for countries than creating a whole new institution and trying to make that transparent and well-governed. Yeah. So what we see in some countries in recent years is that they have received resource revenues, and they've maybe invested those resource revenues well, but then they've been borrowing elsewhere in the budget, and it's the debt that then has caught up with them and created problems. And so we encourage governments to take a holistic picture at the budget situation, not just focusing on the resource revenues, but ensuring it's balanced with sustainable debt management as well.
Yeah. The other recommendation that I really liked is taking a regional approach to these resources rather than a nationalistic approach. Let me hear how you guys suggest how that would work.
Yes. So, well, it's fantastic to see the momentum and the political will behind the Continental Free Trade Agreement. And so we encourage countries to seize the moment. The nature of mining value chains is there's a lot of potential for African countries to add value to their metals and minerals before they leave the continent. But as we know, many countries on their own are too small or only have specific capabilities and comparative advantages, such that joining forces at a regional and continental level is likely to yield much greater benefits than trying to do everything on their own.
That's it from the Southern Africa team. It's back to you.
Thank you so much for the updates there, Palesa. Up next, we have Sarah on standby to take us through some of the highlights from the east of the continent.
Despite sub-Saharan Africa having around 15% of the world's Muslim population, Islamic banking assets in Africa comprised only 2% of global and less than 10% of total domestic banking assets in most African countries, and that is as of December 2021. We had an in-depth interview with Abdelila Belatik, the Secretary General of the General Council of Islamic Banks and Financial Institutions.
And because of the lockdown, all over the place, all over the world, and many sectors of the economy, the tourism industry, the services, and so on, they have been heavily impacted, and in particular, many of the SME sector that they were impacted. So during that period, we saw a very positive transition and on the digitalization space for the banks, for the Islamic banks. So many of the Islamic banks that were planning for digital transformations, perhaps in the next 3, 4, 5 years, they brought forward most of the product that they had to cater for the needs of their customers. So this and with many of the government initiatives to support the economy and in particular the small and medium enterprises, this was very beneficial. And going out from the pandemic during last year, like mid of last year, so we saw a great rebound on openings of the economy. And based on this, there is like a few factors that were perhaps impacting the financial sector and will continue to impact for the next few years. Is the digital transformation is one area where has been very significant improvements leading to economies of scale and reaching to customers much more easily. And the second area is the shift that we have seen on ethical financing and looking perhaps with a different eye to sustainability practices, which is aligned with the objectives of the Islamic finance values and Sharia itself. So this made it easy perhaps for the Islamic banks to navigate into these new trends and new areas, which will be potentially much beneficial for the future for Islamic finance. And then because of this, we have seen for last year strong growth in most markets. That's where the Islamic banks are in GCC, in Africa, in Southeast Asia. So it's like consistent growth markets, and we still continue to see this trend ongoing. Some of the research that we do, we see that in most regions, Islamic banks, at least they have at the same level or outperform their counterparts in many of these regions. And coming to the African region, I think there is perhaps, and we see it a lot of time, this is probably the region that has the most powerful growth potential for now and for the coming years. Because while we see, for example, in some existing and matured markets in GCC or Southeast Asia, still growth continues, but with perhaps slower growth potential. What we see in African markets, even though the size is still small compared to the other regions or compared to the financial sector in Africa, we see the growth, very, very high growth potential. I mean, it's more than double digits. It's year on year what we have seen for the last maybe 5 years. For example, from 2017 to now, we have over 250% growth.
3 years since inception, KIFC, the body charged with the responsibility of transforming Rwanda into a regional financial hub, says there is an urgent need to close the skills gap within the financial system. Nick Barije, its CEO, sat down with CNBC Africa's Eugene Nangwe to discuss this and more.
Our chosen path has always been to identify partners for which we share mutual interest. For example, for Kigali International Financial Center, we have partners such as the Monetary Authority of Singapore that is quite advanced in this space. So in June this year, we're going to host a global fintech event. We are calling it Inclusive Fintech Forum. We are partnering with the Monetary Authority of Singapore to bring policymakers, those with capital, and those young Africans that want to showcase their brilliant ideas. We feel this is very important, and it's one of the avenues of trying to address challenges that are not only specific for Rwanda, but are specific for Africa. So this is a case in point. The other case in point is that even within Rwanda at a national level, we've been working with the Ministry of ICT, with the National Bank of Rwanda and other stakeholders. We just finalized Rwanda's fintech strategy. We are now moving into the phase of implementation that calls setting up a secretariat that now begins to identify at a national level what are those challenges and how do we address them. So we have different strategies that we're embarking on, but the key here being identifying partners for which we share mutual interest and then work together, because we are not coming out to say we know it all, but we believe we have an attitude of collaboration to address both national and regional challenges.
Right. With all the options that a potential investor who's looking for a financial center, with all the options that they have in mind, including the one in Nairobi and other spaces, Dubai, why should they choose Rwanda, in your opinion?
Rwanda is an alternative. Investors have a choice. What they see in Kigali International Financial Center is a couple of things. One, Rwanda's global reputation on issues around transparency and compliance. Those are the heart for investment decision making. Number two is Rwanda's connectivity. Investments that the government of Rwanda has made in Rwanda Air, in the upcoming airports, those give an investor an opportunity to connect with other countries around Rwanda. So our geographical positioning puts us in good standing, and the investments that have been made complement Kigali International Financial Center. Third is around our ability to create a very conducive environment. If you recall, Jean, is that in February this year, we launched an expanded one-stop center. This is very unique to Rwanda, where you're having regulators, you're having policymakers, you're having different institutions of government in one space to be able to work together to address investor needs. So three things: one, strong global reputation on transparency and compliance; two, Pan-African connectivity; and three, a very enhanced environment that facilitates doing business not only in Rwanda but across the region. That's what Kigali International Financial Center has got to offer.
And that's all we have from East Africa this week. It's back to you, David.
Thank you so much, Sarah. Now, bringing the conversation to West Africa, a paper by PricewaterhouseCoopers says Nigeria stands to benefit from the export of brain capital into high-end global value chains if it takes advantage of its large youthful population and supplies skilled labor to the global market. Well, Andrew Nevin, the chief economist at PwC, shed some insight into the details of the paper. Take a listen.
So before COVID, we put the paper that said, contrary to many people's belief, oil is not Nigeria's biggest export, it's brains. And that was looking at the diaspora remittances. I mean, to put it into context today, in 2022 and 2023, there was zero remittance from the NNPC to the Federation account. and there were $20 billion of official remittances from the diaspora. So there's no question that our biggest export is actually grains in the diaspora compared to oil. And we called it the barbell economy because oil is the least high value added, least valued commodity on the planet, and grains are the highest. So our economy in export terms is a barbell. We export the most valuable thing and the least valuable thing. But of course, we all understand JAPA, diaspora, it's not ideal. It puts some pressure on services in your healthcare, for example, and brain drain worries. But in the modern world, you can now deliver high value added services without necessarily leaving the country. And I don't think we put a number to it. No, NBS certainly hasn't, but I'm guessing there's probably several 100,000 Nigerians who today live in Nigeria and work in global value chains. And their value in those global value chains is much higher than it is in Nigerian value chains. And because of the impact of technology and because of the impact of COVID, there's many more ways to participate in these global value chains without leaving Nigeria. So people don't have to JAPA to be earning FX, be earning high wages. They can stay in their communities, take the money, buy houses, go out to restaurants, drive the rest of the economy on that. So that's what we're asserting. And we put a target of 2 million jobs by 2035 in global value chains with Nigerians staying in Nigeria. So that makes our biggest export Nigerian grains.
Exactly. And also one of the highlights from your note is also looking at the fact that earnings of Nigerians through GVCs are significantly higher than their counterparts. And in terms of the readings now with this grain export, how do you see this feeding into the numbers, the likely forecast or trends we'll see in terms of remittances? That still remains a big concern for Nigeria, looking at relations with the diaspora.
Well, just in terms of the value of Nigerians in global value chain. So I don't know, I'm sure many of the watchers today saw Taiwo Awoniyi score 4 goals in the last 2 games for Nottingham Forest. And he's basically going to keep Nottingham Forest up in the Premier League. Fantastic Nigerian export. He has a transfer value now estimated at about 25 million US dollars. If he played in the Nigerian Football League, the highest paid player I understand is about $35,000. So by being part of a global value chain, the global value chain for football, Taiwo Awoniyi is worth 100 or 1,000 times more than he is in Nigerian value chain. But of course, it's not just athletes that can do that, or performers like WizKid or Fireboy or Tiwa Savage, who performed at the coronation, for example, last weekend. I mean, it's many Nigerians, millions of Nigerians can do this. As I said already, 100, 200,000 at least, maybe more even. And these jobs are available. And of course, in terms of the global demographics, the workforce outside of Africa is shrinking. So where are we going to get the young people to do all the important jobs? And of course, more jobs require brain power. So we have 28 million programmers in the world today. We need about 45 million in 2035. AI just means more programmers are needed. We should be supplying north of 1 million of those programmers by 2035. So the opportunity is huge. It fundamentally changed the balance of payments of Nigeria. We can afford to import what we need to import, and it makes much more sense for us to sell grains at a high value and then import low-end manufacturing goods than try to enter the manufacturing value chain at the low end, like a country like Korea or a country like Vietnam or, of course, China and that. So we already export the highest value added thing in the planet. Let's just build on that and export a lot more of it.
And next up, a report by the Bayelsa State Oil and Environmental Commission says it will cost about $12 billion to clean oil spills and oil and gas pollution in the state over a 12-year period. The Commission has singled out Shell and ENI to pay the majority of the cost alongside other oil companies operating in the state. CNBC Africa's Esther Awoniyi caught up with Executive Governor of Bayelsa State Doye Diri on the facts behind this report and how to achieve a statewide cleanup.
The report is that we will implement that report, and we will implement it with all that we can muster strength on. That report captures the age-long struggle of our people. We are just marking Adakaboro Day yesterday, and that was the beginning of the struggle of the level of pollution and degradation in the Niger Delta by Adakaboro of blessed memory. And so for us, that report means a lot. And the implementation of that report will redress issues of environmental justice, the issues of environmental degradation and pollution. And so my initial response is that the government of Bielsa, in league with the communities, will ensure that that report is implemented.
Mr. Governor, in the last 30 years, there have been numerous reports, commissions, regulatory initiatives, and of course civil society advocacy. Now, these have brought the plight of the Bielsa people to the world, but did very little to significantly alter their situation. Why should the people of Bielsa State have confidence that this report, this latest report, will make any difference?
This is a different report from any other report. This report is scientific. This report is based on facts and figures. This report is one that has never been in the whole of Niger Delta, Nigeria. So I am very sure that this report is significantly different from any other report that has been in the bookshelves in doc. And this report will not be one of those.
Now, in their defense, international oil companies, as you probably already know, have often said that, have often blamed pipeline vandalism, oil theft, sabotage for the environmental degradation. What do you say in response to that? One. Two, the report also points to the federal government. It not only talks about the activities of the IOCs, it also says that, of course, they were doing this in partnership with the federal government, so, you know, also asking the federal government to take some responsibility. What is your response to that?
Well, the people we know are the multinational companies that operate in our territory. And whatever partnership that is between the oil companies and the federal government, that is between the two of them. And for us, those who are in our immediate environment are the people that will be held culpable. And they are the people that have been dealing with our forefathers, with our fathers, and are still dealing with us today. And so for us, when we hold them responsible, they will go back to their partners. The issues of sabotage are neither here or there. I've not seen any oil spill where any of the multinational companies have owned up from the beginning without recourse to saying it is sabotage. No oil company will come out initially to let you know or to tell the world that there is an equipment failure.
And on that note, it's a wrap on this week's show. Thank you so much, Peles and Sarah, for the regional updates there. Join us same time next week for even bigger conversations. I'm David Alabi. Do have a wonderful weekend.